Rolling Stones once had a phrase in a song that proclaimed, "You can't always get what you want." That phrase is very appropriate when trying to understand economic limits, alternatives, and choices. In this lecture, we will define economics and the key features of the economic perspective. Economists make assumptions and generalizations when describing a theory. We will examine some of the major ones. Managerial economics, or microeconomics, deals with the individual and the firm. Macroeconomics looks at the country as a whole. We will be spending all of our time in this class on managerial economics, but I wanted to give you a perspective and the differences between the two. One of the key learnings will be the difference between positive economics, just the facts, ma'am, and normative economics, or the way we would like the situation to be. Understanding these two different concepts will help you to listen to economic reporting with a sharper ear and a clearer focus. And then finally, we're going to explain the individual's economizing problem, the budget line. Economics. Economic thinking has several critical and closely interrelated features. It's a social science that is concerned with making optimal choices under conditions of scarcity. It makes an assumption that economic wants at the individual, company, and country level exceed society's productive capacity. You can't always get what you want. As business leaders or economists, we will be faced with situations where the resources available to complete a project are limited. We will not have unlimited labor or capital at our disposal. So we need to understand the economic perspective. First, we can't have it all. So we need to understand scarcity and choice. We must decide what we will have and what we need to give up. First, let's assume that society wants to make iPhones. It takes quite a bit of resources to get this done. The resources used to make iPhones can't be used to make big computers. So there's a sacrifice. Economists call this sacrifice opportunity cost. At the individual level, economics assumes that human behavior reflects their rational self-interest to increase their own utility. We satisfy others' needs when we earn a wage. So, self-interested behavior is simply behavior designed to increase personal satisfaction, however it may be derived. Hopefully it's legally, but you can imagine that this is not always the case. Firms also try to increase their own utility by providing products that customers want at a profit. Business leaders pursue the self-interest of the firm. Country leaders behave the same way. One of the examples I would give is the pursuit of security for all the people that live in a country. At the margin is an important economic concept. Marginal means extra or change in. Should you buy another piece of pizza after you've already purchased and ate 3? That extra piece will have a marginal cost and give you a marginal benefit. Is the marginal benefit worth the marginal cost? If the marginal benefit is greater than the marginal cost, you'll continue to buy pizza. You will if the marginal benefit is greater than the cost. Is the satisfaction of hunger that benefit better than the cost of heartburn? You'll continue to get more pizza. Should you study one more hour for an exam? If the marginal benefit, better grade, is worth the marginal cost, the opportunity to read more of your favorite novel, then you'll study one more hour. Marginal analysis is determining the answer to those questions. Does the marginal benefit outweigh the marginal cost? And in all situations, I like to explain Tinstoffel. There's no such thing as a free lunch. Everybody has to make trade-offs, even Warren Buffett. Economics relies on the scientific method to form theories of behavior. A well-tested and accepted theory is referred to as an economic law or an economic principle, a way to describe how the economy operates, or the individual firm operates. For example, it's generally accepted that an increase in price of a good or service will lead to a reduction in demand. However, unlike chemistry or engineering principles, economic principles are based on data and observation of individuals, business, and governments pursuing their self-interest over time in the real world. There's no petri dish here. There's no engineering lab. So, to construct theories of behavior or models, economists need to make some assumptions. They define theories in terms of averages and tendencies or generalizations. For example, an increase in an individual's disposable income will cause them to increase their consumption of goods and services. Kind of a natural tendency to buy more when you earn more. As you would suspect, there are quite a few moving parts in the real world. To form theories of behavior, economists look at the variables being considered and hold all other factors as constants, or the Latin ceteris paribus, all else equal. Many factors can change the demand for newspapers. To examine the effect of price on subscriptions, economists would hold population movement and the growth of the internet constant. A simplification. Many economic models are expressed graphically. Be sure to review the PowerPoint presentation in the module on graphs. It'll give you a good foundation for interpreting data in the rest of the modules. There are two, what I would call, sectors of economics. First is microeconomics. That is where we are at in this semester. Microeconomics looks at decision-making by individual customers, workers, households, and business firms. Thus, in managerial economics, we will look at demand and supply at a consumer or business level, and inputs used in the production of goods and services, wages, the economics of natural resources, healthcare, and immigration. It's about at the individual or individual firm level. Macroeconomics is completely different. Macroeconomics examines the performance of the economy as a whole, the big picture. While the United States economy is the focus, the principles of aggregate demand and aggregate supply work in all market economies. Macroeconomics cares about total country output, employment, and income. These subjects are covered in a separate class. The concept of positive and normative economics are important to understand as students, voters, and importantly, business leaders. When you're listening to a podcast or watching television, you will hear individuals proclaim the tax rate should be lower in this country. It's a proclamation of what should be, or what they would like to have. Other examples would include employment needs to grow faster. Worker students need a higher minimum wage. We need to repeal and replace Obamacare. These are normative economic expressions. They're economic statements that involve value judgments. Positive economics deals with what is. What are the facts? For example, the average tax rate in the United States is 22%. Employment grew at 1.5% last year. Worker students currently earn $8.25 an hour without overtime. Students and voters confuse these two principles. Positive economics are economic statements that are factual, not value judgments. Economists make the same mistakes too. Most of the disagreement among economists involves normative, value-based policy questions, not about the facts. Know the difference between the two types of expressions when confronted with an issue. Look for these two types of statements as you're doing your current event topic by looking at leading business publications and about what they are writing. You can't always get what you want. Individuals have limited income. Some say we have unlimited wants. We want the iPhone, iPad, new car, vacation, grad school, etc. Because of our income, we must prioritize. We must have a budget. To conclude this section of the lecture, we will review the budget line. The economizing problem is a comparison between limited income and unlimited wants. In order to understand that, we must develop a budget line. We're going to review this in this lecture at an individual or household level. The focus will be on attainable and unattainable combinations of purchases and how we make trade-offs as consumers, and how we understand the opportunity costs. Let's assume a few things. There are just two products that we can purchase: DVDs or books. It's a simplifying assumption. And we have $120 worth of income that we can expend. The price of the DVD is $20 and a book is $10. So as we can see from the table on the left, we can purchase 6 books or 6 CDs or 12 books, given our budget constraint of $120. You can also see the slope of the line connecting these two extremes. This represents the trade-off or opportunity cost line. So the line represents all the points in between that we can do to purchase any combination of DVDs or books as long as we stay within the budget of $120. A few observations. Any combination below the blue line is attainable within the budget of $120. We don't have to spend all of that money. We could save some of the money, but if we wanted to spend it all, we have to spend along that blue line. Attainable would be an area where we're actually saving some money. Anything to the right of the downward sloping curve is unattainable. So we have a choice. What combination of CDs and books would we like to purchase with our $120? What combination is in our self-interest? Each consumer will have a different combination and obviously a different budget. Finally, the slope of this line is our opportunity cost. For each CD that we give up, we can have 2 more books. Conversely, we have to give up 2 books to purchase 1 CD. As John Haywood wrote in one of his proverbs, you can't have your cake and eat it too. You have to make some choice. We will learn later that society has the same budget problem. With scarce resources of land, labor, capital, and entrepreneurial ability, we must prioritize what we do as a business and what we do as a country.